The defining feature of private market investing is liquidity, or the lack thereof. Investing in private markets begins with a commitment of capital. The private equity firm, or better, the general partners, then draw down from the committed capital in subsequent cash calls when deals present themselves. The exact timing of these cash calls can't be anticipated with certainty. What's certain is that capital will be drawn down in the years following the initial commitment. There's not a liquid secondary market for holdings in a private markets fund. So, investors expect not to be able to liquidate their investments before maturity, given the usual multi-year investment horizon. A private markets fund normally starts distributing cash after a few years. Often distributions to investors, the limited partners, can occur as the general partners are still calling cash from the committed capital. The fund is then liquidated in the final years as the private equity firm performs the designated exit strategies. As you can notice from the two charts on the left of my spreadsheet, capital contributions after the first few years following the initial commitment and the distributions to limited partners overlap significantly from year 4 to year 8 approximately. An investor wanting to get an exposure to private markets has to take into account the allocation to the asset class would be minimal in the first 1 or 2 years after the initial commitment, will peak at around year 6 in the example you see on my spreadsheet, and will start declining afterwards. So, getting a strategic allocation to private markets needs some tweaks. We need a model to estimate the pattern of contributions and distributions. Why do we need to estimate contributions and distributions? At least for 2 reasons. The first is that the initial commitment implies that when a cash call is received, the investor has the liquidity to meet it. And second, the investor can try and forecast what is necessary to get the desired exposure and maintain it over time. It's called commitment pacing, defining a schedule that targets annual investments over a multi-year horizon to maintain a more stable allocation to private markets.